Hello there everyone, today's video is a combination of talking about corporation tax planning, income tax planning and some investing. So let's consider the following example. Profit and loss account of a trading company. So let's assume you are an owner, manager, director, shareholder of your own company and typical P&L. So for this particular year, you've had 200 grand's worth of sales. Cost of sales 100,000, gross profit of 100,000, admin expenses 25 grand. So you're left with pre-tax profit of 75,000, assuming that's also the taxable profit. So 75,000 pounds profit gives rise to corporation tax at 19% of roughly 15 grand. Okay, so you could wipe out your corporation tax bill by doing a pension contribution for £75,000, assuming that you have capacity brought forward from the previous year. The rules are you can put £40,000 a year into a pension fund, but if you haven't done the 40 grand for the previous 3 years, whatever you haven't put in, the difference between what you have put in and the hypothetical maximum of 40, you carry it forward. So assuming in this example, the taxpayer could do 75,000 to wipe out their corporation tax bill, but in this instance they haven't got the cash. We're close to the year end. We've done projections. This is kind of month 11 or 12 where we've worked out that the pre-tax profit's going to be 75 grand. We say, right, how can we reduce the corporation tax? Can you do a pension? Sounds good, but there's no cash in the company. For whatever reason, the cash has been taken out as dividends or it's been invested in plant and machinery. There just isn't 75 grand left at the year end to do a pension contribution from the company into the owner-manager shareholders pension pot to wipe out the corporation tax. So if we haven't got the cash, what do we do? Well, consider this idea. Let's assume the same director shareholder has an ISA. And maybe there's a few hundred grand sat in the ISA, of which, just looking at a chunk of that, 75 grand's worth of investments are in 3 funds, say 25 grand, 25 grand, and 25 grand. And these funds are with a low-cost online platform such as Hargreaves Lansdown or possibly AJ Bell. And the individual says, look, I will liquidate those funds, in other words, sell them, turn them into cash. So then there's £75,000 sat in the ISA. And the cost to do that, let's say it's pretty low. It could be, some of these online platforms charge £15 a transaction. So to turn these 3 funds into cash could cost 50 quid, maybe 100 quid max. So then you've got 75 grand. And then this individual takes that 75 grand out of his ISA and lends it to his limited company. So it goes in as a director's loan account transaction, a credit on his director's loan account balance, 75 grand. But crucially, from a corporation tax point of view, there is now enough cash in the business to fund a corporate pension contribution. 75 grand comes in, so we do the pension contribution of 75,000. That saves 15 grand of corporation tax, taxable profits 0. So then, 75 grand straight into the pension. So this is a self-invested personal pension, it's a SIP, and the individual says, well, actually, I quite like those funds that I've just liquidated. I'll buy straight back in. So pot 1 or mini pot 1, mini pot 2, mini pot 3, the same 3 funds, 25 grand, 25 grand, 25 grand. So it's the same investments that we had in the ISA are now in the SIP. And again, low costs on these platforms, these providers of pension wrappers, maybe 50 quid, 100 quid. So we basically switched our investments from being in an ISA to being in a SIP. Because of course, when we sell them in the ISA, that's tax free. There's no capital gains tax. That's the beauty of the ISA. So there's no tax at all for for liquidating these three funds within the ISA and getting the money lent to the limited company. Only modest costs in the tens of pounds, that's it. And again, because we don't want to lose out on the tax-free growth on those investments by not being an ISA, well, that's fine, because they're in a SIPP. And again, the tax-free growth, tax-free yield in the life of the SIPP. So, but what happens at the back end? The back end when we come to crystallize the pension. So just looking only at this 75 grand tranche of the taxpayer's pension, assuming in retirement they're going to be a basic rate taxpayer, what would happen? Well, on that 75 grand, just looking at that in isolation, 25% of it is tax-free. 75%, the balance, taxable. Now, if they're a basic rate taxpayer in retirement, 20%. So on that same 75 grand, had they have left it in the ISA and pulled it out in retirement, zero tax. But it now was saying, actually, you're going to be paying tax at 20% on 75%, and there's tax-free amount on 25%. But then, of course, you've had the tax relief back here on the corporation tax. So when you crunch those numbers on that 75 grand amount, yes, you're saving 15 grand in corporation tax now, but you'll pay around about £11,500 tax down the line. Could be decades down the line. This is when you crystallize this pension pot. This guy's in his 40s, this may be 25 years down the line. But just looking at the tax leakage at both points, you're saving 15 grand here, you're going to pay 11.5, could be many, many years down the line. So you are up purely from a tax point of view, you are up because you are saving more now than you will pay in the future. Okay, so not a bad idea. But what I like about this, better than just the tax differential, which is a modest saving of about 3 or 4 grand, is this DLA credit. The fact that you've lent in 75 grand into your limited company means you can extract that in the future tax-free. So normally on cash extraction from limited companies for direct to shareholders, we'd pay a dividend. Now, assuming this guy is a higher rate taxpayer whilst he's still in business, and we assumed he's going to be basic rate taxpayer in retirement, but whilst he's still working, has his company, he's higher rate, any dividend that he pays himself out of the profits of this company will be taxed at 33%. But here, he's got 75 grand that he can get out tax-free because of this DLA credit, because of the fact he's lent it in from liquidating some of the investments in his ISA. So not only are we a few grand up on the deal, as it were, because the corporation tax savings more than outweighs the income tax payable in retirement, but there is this big 75 grand DLA credit which can be extracted tax-free at any point that the company is in existence and can afford to repay the individual. So that's just an overview there on investing, tax savings. We've got a real combination. We've got all sorts going on here. We've got corporation tax saving, income tax saving. We've got investing. And like I said, because of the fact that the tax breaks of an ISA means there's no capital gains tax to get part of this fund out, and it doesn't cost much from an admin fee to do this. Same with a pension. This is why it's something to consider, perhaps. Now, this 75,000, of course, it can be a higher amount if the individual had more profits, more taxable profits before the pension contribution, and their capacity to do more, because let's say like I said, you got 40 grand a year, but if you haven't done any pension contributions in a while, in theory, that 75 could be another 50 grand on top of that or more, depending on the circumstances of the individual. And then, of course, the higher the amount is, the more you are up on the tax differential, as it were. The difference between what you save now and what you pay in the future will be greater in absolute terms the bigger the amount that you're doing this planning with. So just something to think about there. Particularly if you've got a taxable amount, you've got taxable profits in your limited company, and you like the idea of paying a corporate pension contribution to get your tax bill down, or potentially wiping it out, but you haven't got the cash in the business to match the profits that are on paper because it's at the end of the year and you might have taken the cash out as a dividend or invested it or whatever. This is a way of reintroducing some cash to make it match the profits, to then pay the pension, to wipe out the profits and wipe out the corporation tax. So, something to think about there. If you like this video, please do subscribe right about there, and I'll see you soon.